Okay, good evening, everyone. This is March 1st, Friday. Had a very exciting week in the market. For those of you who are joining us for the second time, I appreciate your time so much. This time, I think what I'll do is I do have some prepared set of analysis that I'll share, but I do want to leave time for interactive questions. Last time, I know I kind of covered some basics. And most of the time was spent really walking through how to really read charts, how to look at trends, and so on. But I think your comments were very valuable. And I think what we would do today is after I cover some of the insights on the market. By the way, we do have, again, huge thanks to Rohan for this awesome Substack blog site. It's chartsurfun.substack.com. So you're welcome to, it's free. You can go there and check out the blogs. We try to post one every day in the morning times. You can take a look, often covering something that's trending the previous night or that morning is what the blog is about. And also, and so this is the blog page, and you can see that today posted something about Apple. Yesterday was about utilities, and then this is about international investments and so on. And Rohan also got the recording of the last week's session on YouTube, and that link is available. On the YouTube, I really encourage and appreciate you, all of you, to after you look at the video, if you like it, to please hit the like button. It just gives us more of a concrete feedback about the video, and feel free to comment. We'll try to check and then try to respond if you have particular comments or questions about anything that I covered. And you're also welcome to send me email, and I'm happy to cover that as well. So today's topic, we are 5 after, 6 after. Without further ado, just let's go right in. So let me walk through some of the core blogs that were posted this week. But before I do that, someone shared this very exciting LinkedIn post, and happily we'll share this link through, Rohan can share it through WhatsApp or through email, by the godfather, one of the godfathers of finance. His name is Ray Dalio. Many of you know him. He's actually, many people call him the Steve Jobs of the hedge fund industry. Very innovative guy. He founded and runs a very, very large and extremely successful hedge fund called Bridgewater Associates. And he's retired, is of course the founder, but retired and acts more as the Chief Investment Officer mentor, interesting title that he has, and also member of the board. Now, we've been hearing a lot of buzz about, are we in a true bubble? And especially with the trending and the parabolic movements in stocks with AI and so on. And he made an interesting post. And what's nice about Ray Dalio is he's very grounded. He does very thorough analysis. There's very, very nice videos of him on YouTube. Great interviews. I think he's done several TED Talks. And he's a very strong economist at heart, and basically fundamentally looks at the economy, looks at macro trends and so on. And what is interesting is in this question that he asked, that are we in a stock market bubble? Because that's the trending thing that we often hear out in the press. So he defined bubble as something where, call it these 6 measurements from his objective analysis of what defines a bubble. One is high prices relative to the traditional measure of value, unsustainable conditions, where, extrapolating past revenue and earnings late in the growth cycle can't be sustained. Many new and naive buyers are being attracted in the very late stages of the rally. Very, very broad bullish sentiment across the board. So there's euphoria, extreme in sentiments. High percentage of purchases being financed by debt, where margin debt shoots up in the very bubblish situation. And a lot of forward and speculative purchases happen, betting on price gains, and people tend to just pile on and go make those purchases. So combining all those things, he basically plots out a gauge of his own called the bubble gauge. And this is for the US markets. And it's, in this case, primarily showing the bubble gauge related to equities in the US. So talk about the S&P 500, the broader NASDAQ, and then the New York Stock Exchange, the 3,000 to 5,000 stocks that are in the US stock exchanges kind of is what this is collectively measuring. And he's drawn this out over the last 24, 25 years, starting off from 125 years, starting off from 1900. And he's basically plotted out basically when it's above this line here. It's in a lot of ways like an RSI. Anything above 70, I think, is where he's plotted out bubble ranges. So obviously, you notice that around the late 90s, 99, 2000, we were in the bubble range. Very recently, the bubble range actually happened in 2021. As we came out of the COVID crisis, tremendous amount of liquidity around the world splashed out by the central banks. And we saw tremendous amount of speculative buying. That's when a lot of the SPACs came out and so on and so forth. And that led to a very, very sharp move in the markets with tremendous amount of risk taking that then did cause, from valuation perspectives and a bubblish-like phenomena, that then had a very sharp collapse. And that's the 2021, late 2021. Actually, very interesting enough, the broader market topped out more towards March of 2021. That's when most of the SPACs hit a peak, and many of them started correcting. And the broader market, however, whether it's the NASDAQ or S&P, didn't top out. NASDAQ topped out in November of 21, and S&P topped out a couple of months later, early Jan of 22. And then we know that we got a very sharp correction for like 10-month period. And in October 2022, we bottomed out. Then again, we had an upward movement, and then we had the March Silicon Valley collapse, and that's when we again dropped in the market. And that dropped kind of, dropped from late January, like early February to March, came back up again. And then October of 23 was when we hit another bottom, a higher low than the bottom of October 22. And then since then, we've just had an absolutely amazing rally. And we'll shortly look at performances and so on. So from his perspective, when he draws out his bubble gauge, he shows that's where we are. We are in the 52nd percentile, nowhere close to the 80s or higher, as we've seen in the past bubble situations. So that's one. He then zooms out the 1920s bubble, which actually happened preceding to the Great Depression. In the late 20s, 28, 29, we had a bubble in the market, and then a very sharp drop, 90% drop in that time period. In a similar way, in the 90s bubble, the irrational exuberance by Greenspun statement, all of that led towards, and that was the dot-com classic bubble, 98 to 2000. That's when we saw that bubble territory and then a very sharp drop. And in today's environment, he is circling out the bubble that we recently saw in 2021, and then the drop into 2022. But coming back out of it, yes, we have definitely come up from the 2022 bottom, but nowhere near that bubble territory yet. We are still in that 52nd percentile with more upside left. And then this whole idea of the Magnificent Seven was something that came up. And in many ways, those are like, call it, in fact, the top 7 momentum stocks. Also, many of them are actually in the top market caps. Just that Tesla's market cap has dropped a lot, but the others are, like, you can quantitatively say they're number 1, 2, 3, 4 like that. So number 1 being Microsoft, number 2 being right after Microsoft is Apple, number 3 is NVIDIA, number 4 is I think Amazon, then Google. So in that order are those stocks, and those are all part of the Max 7. And then he basically looks at some of these measurements on a Max 7 basis, and then basically highlights that some of the Max 7 stuff with respect to the 90s bubble to today are still there, but not fully to the, these are the 12-month forward PE ratio. And you notice that it's not in the, to the level, it's still in the, 25 to 30% is where the broader, relative to the growth, he's comparing the PE ratio. So if the PE ratio is in the 25 to the 30 range, and your growth is also in the 20 to 25 range, there's this term called PEG, P ratio over growth. And if a PEG is around 1 to 1.5, it's actually reasonably priced. When a PEG crosses 3, 2 plus 2 to 3, that means your P ratio is double your growth or triple your growth or 4 times your growth. Then things are frothy. And in this case, it's not really. The PE ratio is about the same level as where the earnings growth is, the 12-month forward earnings growth. Anyway, so this was an interesting post. You guys are welcome to go take a look. But highlighting that there is still a potential upside in the market was his assessment from a valuation perspective. Now, there is this option in stock charts that you can do in here. If you click on the top bar, it's called perf chart. And perf chart basically lets you do performance comparisons on any time frame across a bunch of symbols. So here, what I've done is I've taken the first one is, of course, the triple Q, the NASDAQ 100. And then I've taken the MAX 7 ticker symbols, Apple, Amazon, Google, Meta, Microsoft, NVIDIA, Tesla. And through the colored lines, you're plotting relative performance, starting from the 26th October was when the market bought, 26th October 2023 was when the market bottomed out. Interesting enough, you notice that the market, these Magnificent Seven, all rose from that bottom. And they're in a tight band till the point when the divergence really came in the beginning of the year, right from 2nd onto, well, right from 4th or 5th January is when the entire thing started diverging. Before that, yes, there was a band, but they were all moving up along the band, except maybe a little bit of move away. In this case, Alphabet was slightly moving away in November. But overall, you can see it's kind of in a band kind of a movement. The Magnificent Seven were going up together till the point came, and then a broad divergence came. One of the big divergence that happened was in Tesla. We all know that Tesla got a lot of negative news in January. It was the harsh winters, and there were cars stranded in Chicago, in the Midwest region. There was anxiety issues with the range in charging cars, batteries froze up. There was also, sales misses. There were weak sales in China. There was just overall price cuts going on, a lot of negative sentiment. And then, of course, the biggest thing was his compensation kind of got turned down at the, I think at the Delaware court level. And so there was a lot of negative news around Tesla. And that's clearly one of the stocks that underperformed starting from that early January. And that's the bottommost one. In fact, that's the only Magnificent Seven starting off from that 26th October low that is negative over this. And this is 87 trading days, by the way. So that's negative. So it's at negative 2% is Tesla. However, absolute, great performer is NVIDIA. And we know that it has come up almost doubled in that time period, grew up almost 92% over that 4 months. The second best performing is Meta. Meta, of course, also had an absolutely amazing, and this is the steep climb in Meta, by the way. NVIDIA just higher through. Yes, it fell. This fall was, by the way, the classic drop after Palo Alto Network. That week, we got a drop, and that's when that drop happened. But then since then, it actually absolutely shot up. Actually, no, this drop could have been going into maybe when the CPI data. We did get a market pullback after CPI. Then we climbed up. There was a drop just before the Palo Alto week, and then after earnings, it kind of coasted high. But overall, very positive trend for NVIDIA all along. And there were some of the news coming out that were all Microsoft's earnings, the Supermicro's earnings, all indicating that AI was doing extremely well. The market's expectations for NVIDIA to blow their earnings out of the park was very well grounded, and that's exactly how it did when its earnings came out. However, if you look at the bottommost performing stock, in the Magnificent Seven, just above Tesla, turns out to be actually Apple. And if you look that up, it's just up 8% over this time period. But Apple has been overall, from the early January part, trending. If you take Tesla out, trending at the lower end compared to the others of the Magnificent Seven. So this brought up an interesting point, and there was a discussion that Magnificent Seven transformed into the Fab Four. So Fab Four are really the top four here. So you can see NVIDIA is the number one, Meta is number two, number three in here is the green one is Amazon, and then the fourth one is actually QQQ, but right below it is Microsoft. So the Fab Four really are those four stocks. And by the way, these huge upsides that you see is Meta's earnings, and then the day after was Amazon's earnings. Amazon's earnings also was very strong. That kind of made it shoot up, and then it's kind of trended higher, get above since then. Microsoft, very interesting enough, though it's a big player in AI with a heavy investment on the AI space with Copilot, with its partnership with OpenAI. If you look at its stock performance over the month of January into February, look how tightly correlated it is to the QQQ, which is in red. QQQ is in red, and Microsoft in this case is a slight of I think it's like a black kind of a color. So you notice that it's right one on top of the other throughout the couple of month time period. No divergence whatsoever. So effectively QQQ became, and it makes sense, of course, because Microsoft has the highest market cap, close to 3 trillion. So being the highest market cap, it also has the highest weight. It's a weighted index, QQQ. So it makes sense for it to kind of trend along with QQQ, but you'd expected, because of the other other components in QQQ, that if Microsoft had any diverging behavior, it would have separated out, but it really didn't. It really stayed in par with QQQ is how Microsoft traded. In many ways, that meant that Microsoft was the beneficiary of money moving from a passive investing perspective into QQQ, and as money moved into QQQ, automatically as buying a QQQ, a percentage of that, say 8% or 10% of QQQ is Microsoft, of those shares were Microsoft shares being bought. So it was strongly correlated with QQQ. So that was a very interesting pattern. Now, the fact that Apple really underperformed, let's take Tesla out as a separate use case, like as a separate situation, but from a technology and a gadget company and it's the number two from a market cap stock, the fact that Apple underperformed begs the question, what does Apple's chart tell us? So this was actually in the news this week. For those of you who do watch CNBC, there was a whole coverage of that, I think a couple of days back, by Carter, who's an amazing technician. He's often in Fast Money and many other CNBC shows as well. But he came in and he started talking about his technical analysis of Apple. So this is the weekly chart of Apple. So every candle here is 1 week of trading. And last time I had explained how to read these charts. A hollow candle, as in when you have a candle without any shading inside, as in it's white inside, but it's got a black outline. A black outline means it was a positive week. So Apple that week had a very strong up move from down here all the way up there. And then the following week, it had a down move from up there down below. So red candles are bad and white hollow candles are good. So overall, you can notice when you have an upward trend, you have several sequence of white candles. That means there is a very strong upward trend in Apple. Here is another strong upward trend in Apple from early part of 23 all the way till June, July of 23. That upward trend in Apple also see a lot more white hollow candles. However, when you have the pullbacks, when you start seeing signs of weakness, you'll start seeing the red shaded candles, and that's when selling is going on or distribution is going on the stock. So one type of analysis is to draw trend lines to the peaks and the bottoms. If you draw a trend line to the peak here and a trend line to the bottom, and this is by the way, weekly chart, and in stock charts, one way to do it is you actually should take the log scale off. So I'm just using a linear scale. So every price gap here is at $5 intervals. So then you can start drawing a straight trend lines with a linear scale. And so you didn't do a trend line to the tops and a trend line to the bottom. And you can see that in some ways, Apple printed a potential double top. So 197.4, 199.3, it's in the range of a couple of bucks. But as it printed the second top higher than the previous top, a couple of bucks higher, relative strength index, RSI, was actually at the lower high than the relative strength index when it was at 197. This kind of a pattern is a leading indicator. It's an indicator that says Apple might be topping out, as in when the second top is at a lower RSI than the previous top RSI, that's called a negative divergence. Negative divergence, why? You have a higher value in price, but a lower value in momentum or relative strength. So that's why it's a negative. As in these two are not correlated, or they're not kind of in sync with each other. This is opposite to that, indicating that this is indicating weakness in the stock as it is testing the second top. So that was one part of it, a double top with a negative divergence potentially. And the next part is Apple, enough, when it rose from the late 2022 all the way from 123 to 197, it went from the bottom of the channel to the top of the channel. Then it pulled back. But as it pulled back, strong stocks don't pull back to the bottom of the channel. They stay range bound from the top of the channel to somewhere in the midpoint of the channel, and they kind of stay there. However, Apple did pull back to the bottom of the channel. There was bearish momentum in the stock. Then it came back up again. But as it came back up again, it pulled back. It did not, if you had to extend this top of the channel all the way to the top, it didn't touch that, because for it to touch the top of the trend line goes higher over time. This would have been way over 200, 230, or 240. It didn't go that high. It was not able to make it that high. It failed. And at kind of towards almost 2/3 of the channel, then it started pulling back to the bottom of the channel. But the last few months, last 3 or 4 months, it has been primarily in the bottom part of the channel than in the top part of the channel. Top part of the channel is this part here, right? That means it's keeping to the top line of the channel. Here it's been scraping around bottom, and it tried multiple times to come and test that channel, right? And finally, and each candle here is a week of trading. Last couple of weeks, Apple broke below. That's not a good sign. That means the second most market cap stock, which is Apple, in NASDAQ 100, is just broken below its bottom of the trend line. Look at the volume. Volume is the bar chart, and the higher the bar chart is, and here is the scale of it, by the way. So if you went up there, it's 800 million. We did get an 800 million towards December of 2021. Here we have got somewhere around, say, a little bit less than 400 million. By the way, you can do inspect. If you click on inspect, you can go and hover around there. It'll tell you exactly what the volume was. It was actually 192 million, was not that one, the next one. 354 million was the volume for this week. So a heavy volume than what we have seen for the last entire couple of months. You notice the volumes were lower, right? 255, 326, but this was the highest volume. And it highest volume printed on a week when it broke below the trend line. Also, the other part of a negative divergence is the fact that PPO, which is the price percent oscillator, also had a lower high. So notice, just like the RSI, this is also momentum indicator, meaning that there was negative divergence. And finally, look at the relative performance. So the way you do relative performance is you pick in the stock charts the price performance as your indicator, and you basically divide the price performance of that ticker, in this case the symbol being Apple, by SPX, which is S&P 500. And you notice that from 23 till July of from January to July of 23, that was a completely upward trending relative performance of Apple to S&P. In fact, relatively, it was performing 40% above S&P towards the first half of last year. Then it kind of stayed flat, ranged from 30 to 40. However, after the peak around early December, while QQQ has been trending higher, QQQ actually has gone up over almost 30% since the October low, the Apple relative performance has actually been weakening. That's also a bearish sign. That means relatively it's not moving as fast or as much as QQQ is since the December peak. So that's also a negative sign. So overall, what this means is potentially Apple, if this breakdown happens, the next point it could, and this is a key level at 179, 180. That's where it kind of tested this morning. In fact, the low was 177. So it broke, but then by the end of the day, it covered that 177. It didn't close the low of the day. It recovered a couple of points and closed up near 179. And the key pattern here is if it breaks this region around 179 to 180 in a very convincing fashion and continues the decline, it can easily actually go below. The measured decline is actually near 158. That's how low Apple can go. So that's something to watch out for. The next thing to quickly walk through is in the same time period of these 87 trading days, we looked at the Magnificent Seven. Now let's look at the industry sectors. And there are 11 industry sectors. You can do more, but these are 11 broad, call it the spider for the S&P 500 select spider sectors. The B is for the materials. Materials are like copper, steel, that's XLB. C is for communication services, Google, Meta, those are all Disney, those are all under communication services ETF. E is for energy, ExxonMobil, Chevron, and so on. F is for financials, like JP Morgan, Berkshire Hathaway, these are all in financials. Berkshire Hathaway, interesting enough, actually has a lot of Apple. It also has, so it is a very diverse, company. It basically is an investment company. It has, it takes its cash and it buys out companies. Sometimes it completely owns the company, or sometimes it, when it takes it private and it completely owns the company, or it buys shares, large chunks of shares of publicly traded companies. So Berkshire has a big investment in Apple, for example. It has a big investment in Coca-Cola, in BYD, the Chinese company. There's a bunch of diversified. In fact, Berkshire Hathaway has also done very well because of its investments in Japan. As we know, Japanese index has done extremely well over the last few months. Anyway, so but for the fact that it's a financial managed company in the sense that he's a god of finance, Warren Buffett, the father who started Berkshire Hathaway, it falls under financials. It's one of the biggest portion of the financial sector. Then is industrials. Industrials is companies like, all the Caterpillar, Boeing. There are many of the transports that fall under industrials, and industrials also has all the construction companies and all that in there. Technology, of course, is like the Microsofts, the IBMs, all the big, NVIDIA, they're all part of the technology sector. Staples is Procter and Gamble, things that, there's the idea of your need versus your want. Need is typically what staples are. And want is when you basically look at discretionary. Things that if you had extra income, discretionary income, you might buy things that you want. But needs are like your laundry stuff, detergents, your food, Kraft Heinz, your ketchups, or any of those are effectively staples that you need from your day-to-day lifestyle. Real estate, XLRE, utilities, XLU. These are the companies that provide us electricity and so on, all the utility distribution. Healthcare, it's an interesting sector, has all these many of the big cap pharmas. It has the big hospitals, the insurance companies like United Health. They're all part of healthcare. Discretionary is really companies like Tesla. That's by far the biggest discretionary. The other big discretionary is Amazon. Those are the two big components of discretionary. And there are others like Priceline, Booking.com. Those are all discretionary. And then S&P 500 is the broader index. And these are components of the 500 stocks in S&P that fall in these various sectors. So you take the 500 stocks, the ones that are in technology go to XLK, the ones that are in materials go to XLB, the ones that are in communication services go to XLC, is how you divvy up the 500 stocks into those sector components. So now if I look at the October bottom and the relative performance of it, turns out XLK is gained over 30%. That's the one right here, technology. And as you can imagine that with Microsoft and NVIDIA, a lot of the big market cap stocks being part of XLK, it has done extremely well, and it has actually closed at the high. While, notice that from closing on the left to the far right, this is the higher high. It kept climbing to the point where it closed today, March 1st, at the highest gain ever. So not ever, at the highest gain for this time period at close to 32%. The next performing sector, which is in this case magenta, is financials. And close to financials is I think that's the communication services, slightly purplish blue. So you can actually hover over it. The financials is magenta, and then this one is comm services. And comm services is dominated by Meta, and Meta is a big portion of it. So it's the fact that Meta has been doing so well has been driving the communication services higher. And then in cyan is industrial, that has also done extremely well. And then you notice that the next three sectors are closely clustered together, and they've been moving up together, right? So basically, it's the industrials, it's the, let's see, what's the other one? Industrials, and then the S&P itself. So industrials and the S&P are kind of moving in tandem. They're all about 22, by the end of the time period on March 1st, they were about 24 to 25%. The industrials, S&P 500, and then the S&P 500. No, the S&P 500 spiders is S&P 500. And what is the next one? Discretionary. So discretionary and the industrials and S&P 500 are kind of clustered together in the last part of last month. In fact, all of February, you can see that these three kind of were clustered together. And then you start seeing a wide separation out, and the lowest in this particular case happens to be energy. Energy throughout the months of December and January were actually been negative. It went all the way to -6%. However, the recent couple of weeks, it came back up to end positive over this 4-month time period. So it just eked out again on March 1st. It was in fact till 0% gain till in fact yesterday, but eked out again, and now it just closed a little less than 2%. And the one right above that is utilities, which is also underperformed. So overall, you could say that sometimes when you get rotation, money moves out of one sector to the other. If these strong sectors have to see selling, money has to move out. One option is money can go into treasuries, so it can go into bonds. So you can see upswing in TLT. It can go into, say, precious metals, and you can see an upswing in gold. Or you can see just money sitting in cash. With the kinds of interest rates that you get these days, 4.5 to 5%, people could just keep it in cash, might as well. But one of the sectors, which is called the defensive sector, that has been underperforming over this entire period is actually utilities. So then a couple of things to look at is in the top performing sector, especially with Berkshire Hathaway being in the news, their earnings usually happens over the weekend. So last Friday, the earnings came out, and Saturday was when he had his annual meeting, and he talked about his company and how it's doing, and he shared many of his thoughts about markets and so on. Here you can see that the Berkshire Hathaway chart was a beautiful cup and handle. So here's the cup from 373 to 330. And the way you measure a target of a cup and handle is you look at the base of the cup. So 373 to 330, and here is 369, the other brim of the cup. So about $4 off, but roughly it's the left and the right are around the 370 region. And 330, that's 40. So 40 plus 370 is 410. So 409, 410 is where the measured cup and handle target is. However, it over-exceeded that, overshot on the day of earnings because the earnings were strong and it hit 430. However, the day it shot up, very close to the high. In fact, throughout the day after touching the intraday peak at 430, it kept selling off and it closed, 30, almost 20 points below that peak, below 410. by end of the day and with heavy volume. So this was a classic example, a candle indicating distribution or selling. So a lot of the folks who were Berkshire Hathaway stockholders were booking profits and moving money out is when you see this kind of a candle. As intraday, you start seeing, so it's like a candle with a tail, call it, or with a wick. So when you have a candle with a wick, it's also called a reversal candle. And it's got a very bearish kind of engulfing pattern. Why? Because this candle was covering up the previous 3 days of trading. So this, like from the 22nd, 23, 24, all these days of trading, each of those candles were covered up by a single days of candle, where the peak started off at 4:30, but closed at the lows of the day below the lows of the last 3 days of trading. And so that's called a bearish engulfing with heavy volume, which is usually a precursor to a pullback in the stock, picking up steam. And that's perhaps where it's headed. You notice that from that point, the price percent oscillator, PPO, is actually crossed over in a negative fashion. That's a bearish sign. And usually when you have a PPO bearish cross, the histogram goes below the zero line. So that's what it means. The signal line being in red, and then the moving average in black. And the moving average goes below the signal line. The histogram goes below the center line or below the zero line to negative. So that histogram, as this pulls back, this may come in and kind of the PPO may kind of test out the zero level or slightly be above the zero and then start moving higher. So while this is happening, the distribution continues. We can see that it has also underperformed relative to S&P the last couple of weeks. You can see that the ratio of BRKB to SPX has been trending lower. And this indicates that there's a good chance that Berkshire Hathaway could be downward trending over the next few weeks. Now, guess what? Berkshire Hathaway does have a very large percentage of Apple. Like very big part of its portfolio is like hundreds of billion, I think a couple of 100 billion of Apple shares it owns. So if Apple is going to pull back, as we talked about here, this could not mean good for Berkshire. So in some ways, Berkshire is correlated to Apple because part of its portfolio owns Apple. So this is where it's showing similar bearish patterns between an Apple and Berkshire, something to keep in mind. Then moving into the last month of trading, how did February pan out? And here, when we look at the market, we look at QQQ, which is the NASDAQ, Russell, which is a small cap. Then we have the Dow Jones, which is the top 30, like the big 30 stocks that are part of the Dow Jones index. Then you have S&P 500, in this case in magenta. And then you have gold, which is in cyan. And then in black is the dollar. Dollar as a market basket does trade as an ETF called UUP. And then the bonds, for those that trade a very large ETF in bonds, is called TLT. And that's shown here as the last one. So when you look at the relative performance starting from 31st of Jan, the top 3 are actually very correlated to each other. And they are S&P 500, small caps, and the QQQ. So for the month of, they kind of traded, in fact, if you count today's March 1st as well, 6% for the last 1 month of trading, literally. 6% move in all 3 of the indexes. The S&P slightly underperformed, but the small cap and QQQ were the leaders, a little over 6.5%. The laggard in this particular case, which actually was negative, was actually the bonds. So if you look at the TLT, which is this greenish blue color, TLT actually was down close to 2%. Dollar was steady, flat as a pancake for the entire month, and that's around 0.5% was what the dollar as a market basket. One interesting turnover was gold. Gold was actually trending negative at the first part of February, in the first half of February, till the point that it in fact was negative 2%. And then from there, and this is negative 2% relative to end of January, right? For the month of February, it was trending negative 2%. And then from the second half of February, it started trending higher to the point that it had a big move in the last couple of days, where it closed 2% for the month, for the entire month of February. And right above that is the Dow Jones, which underperformed. And part of the Dow Jones underperforming was a lot of litigation news about United Health, and that is, Dow Jones is the price weighted index. So the larger the price of a component stock, it brings the index down more. United Health is like a $500 plus stock. It by far is the highest weighting. I think is the highest price stock in the Dow Jones. So as a result, it had a big weighting and brought the Dow. It didn't do so well the last part of February. So that's kind of what has happened in the market overall among the core, and this is more of the core US, the technology, QQQ, small cap IWM, Dow Jones DIA, which is the ETF for Dow Jones, S&P is SPY, and then gold, the dollar, and the treasuries. Now, what needs to be looked at next is, okay, where are we really headed with respect to S&P 500? If you look at a 3-year chart of S&P 500 and we look at a weekly chart, every candle here is 1 week of trading, you can broadly pan out something called a cup between 465 to 341. Here it came up to 455 on the right hand of the cup. The cups usually match, but they are a few dollars off. This is like $10 off, 465 versus 455, but a very beautiful, nice symmetric cup was formed over this time period from late 2021 to 2021 to top to the top that we saw around July of last year. Then we formed the handle. That's the pullback we got last summer to 407 at the bottom of the handle. And then the rally started. This is where we confirmed that we were out of a bear trend and a bull cycle had begun. The reason the bull cycle definition could be made is we broke above the previous high. The previous high from the COVID bottom low was at 465. We pulled back to 341, came up from the cup. And then after that, from the month of December, see how we broke up and then kept trending higher. That basically upside target is measured by taking the base of the cup, 341 to 455. That's 114 points roughly. And then if you add 114 points to 455, so that's 655 plus 14, but this is 455.98, almost 456. So that's why it gets to 570. So 570 is where the potential target is. We've climbed so far till the highs today was 513. So we still got another, you'd say 57 points or so to go to hit 570, which is another, 10% from here, right? A little more than 10%, 10 or 11%. However, nothing moves up in a straight line. So let's look at some of the things that needs to be worried about. So this is called the CBOE, Chicago Board of Options Exchange. This is where you actually look at, for all of today's options, this is kind of the most active options that get listed. It's cboe.com, options market statistics most active. And this is an interesting site. It's again free, anyone can go take a look. This tells you the volume of options trades that happen today in the various equity ETFs or equity stocks. It could be a Tesla, it could be SPY, which is the ETF for S&P 500. And guess where the top volume options traded on the puts? They were actually at strikes way below the current strike. Notice the S&P currently is closed at 512. If you look out at where the options put buying was going on today, April 5th, which is a little more than a month out, people were buying strikes at 410, 435, and 460. And look at the volume, 150,000 contracts. Each contract is actually 100 shares of SPY. So in this case, if you multiply this by 100, you're talking about 15 million of shares that were being traded on the S&P at 435 target, right? 460 and 410. So there is some smart money hedging their portfolio, knowing that they have a ton of gains. If there is a pullback and maybe a sharp pullback, having had a very sharp rise, these puts would then come in to play for them. These are out of money. Puts in the money means anything that's above the current strike. So if we closed at 512, 530, 550, 600, those are all in the money puts. These puts, if the S&P doesn't come anywhere close to it, will all expire worthless. I mean, the premium that they've paid on it will just go worthless. You can actually go and check the premium out. There is a site in stock charts for stock options. You can type stock charts. You can go click here options, and you can type SPY. And you can actually go in this site and pick the expiration date. So those are all happening on April 5th. That's a weekly expiration, it's a Friday. And if in SNPY, if you go back and look at those strikes for 150,000 contracts. But look at the premium, 27 cents, 28 cents is the premium. But with that many contracts, that's a significant chunk of money that smart money is putting in. But again, as a hedge, if the S&P comes down a lot, these options will go up, and it'll help them hedge their loss against the broader set of stocks that they're holding in their portfolio. So here there are three strikes where you can see the big volume. One is at 435, 150,000 contracts, 410, 75,000 contracts, and then 460, 70. So what we see here, which is directly off the ticker tape and seeing what kind of options volume happened, is directly correlated at CBOE at a summary basis on this equity options table. So it's another URL to bookmark and to look at it on a daily basis. Gives you an overall idea of where smart money is kind of putting options trades at. Apple, for example, had a very interesting, these all expired today. March 1st was the expiration. So that doesn't help us. A trade on, bullish trade on Pfizer at strike price of 26 was happening with 28,000 contracts. So there's some expectation that, I don't know where Pfizer closed, so we can just quickly take a look. PFP. It might have closed around that price. It closed at 26.59. So perhaps there was, go look at the CBOE side again. There was a lot of calls being bought in Pfizer, 28,000 contracts at 26. So maybe people, and there's also another 29,000, that expired. That was March 1st, but this is March 8th, which is next Friday. So there's a possibility that people are expecting next week to be a bearish week where there might be a pullback. And when pullbacks comes, Pfizer, utilities, these are classic value stocks. These are stocks that are defensive stocks. Money does flow into those. So maybe there's expectation that money may flow into those, and as a result, there was that call buying. Anyways, that was an interesting pattern, but key here is, if you then look at the S&P, the same chart that I showed you from a cup and handle, but now look at it from the trend lines, look at the channels. So from that rise from 341 was the first wave of rise in this trending channel. You can see the top and the bottom part of the channel. Then a pullback from 412 to 374. Then the next channel move happened. Whenever you look at those channels, look at how the first part of the move happens from the bottom to the top of the channel, then keeps hugging the top of the channel from the middle to the top region. And then once you collapse back towards the bottom of the channel, before the final breakdown happens, the last part of the move happens towards the bottom half of the channel. So top of the channel, bottom half of the channel. Same here, the first part of the move is the top half of the channel. After the pullback to the bottom, it's traded in the bottom half of the channel before breaking down. And the same is now going on from the October move. From the initial climb, it climbed to the top of the channel. It was trading in the top half of the channel. And then the pullback came early January. And from there, as we are climbing up, we're not regaining strength to go back to the top of the channel. We are trading in the bottom half of the channel, which means we are setting up, looking at the overbought RSI close to 77, hugging along the bottom of the channel. MACD is almost as high as 2021 levels. There's a possibility that we could be preparing for a trend break and actually pull back. And a typical place to measure where pullbacks come is when you draw a weekly chart, you look at the 20-week moving average. That's typically the point where the pullback comes to. So that's something to look at. Also, that's for the S&P, but also if I look at the NASDAQ 100, last week I talked about this, there's something called bullish percent index, and that measures what percentage of the 100 NASDAQ 100 stocks have bearish looking charts in the bullish point and figure charts. So 67% are bullish and the remaining 33% are bearish right now. But it's been trending lower. At the peak, when the initial part of the climb came, it hit a number as high as 90. And look at how the BP NDX becomes also a leading indicator of a market correction. Whenever you see the MACD in this case go below the center line and carve out a histogram below the center line, you get a pullback in the index. In this case, NDX, the NASDAQ 100 index. Same thing in this part of the MACD. You notice how from September to late October, the MACD histogram, this is of 2022, charted out a curve below the zero line, and that's when the market pulled back. Same thing, the late part of 22, December, and the market pulled back. Into February through March in 23, the MACD histogram dipped below the zero and curved out kind of a bell-shaped curve, and that's when the market pulled back. Similar from July or early August till October last year, MACD printed out a shape below the zero line and the market pulled back. So we are already 2 candles below the zero line, and over the next few weeks, maybe the next few weeks into March, early April, we could print out a similar kind of a curve, like a bell shape below the zero line on the MACD histogram, while the market does pull back on the NASDAQ 100. And it could be a NASDAQ 100 and an S&P pullback to prepare for. So knowing that, something to really look at is what could be a defensive play to do while the market is pulling back? Is everything going to sell off? Or as Jim Cramer said, there's always a bull market somewhere, right? In some sector, some stock, there's always a bull market, because it's rare that everything is bearish. Usually, if something is selling off, there'll be some part of the market which can go bullish. And usually it used to be a bond versus a stock contrarian thing. When bonds are bullish, stocks were bearish, and vice versa. But that has changed recently. These days, the correlations are not as inverse as it used to be during other economic conditions. But this is the another one of the stock charts where you can do seasonality. This is over a 20 period seasonality. And here you can notice that if you look at every month over the 20-year time period, and the time period is on the bottom, you can change it. You can make it 10, 55. So over that time period, you're looking at what happens on average. So there are 20 months of March, 20 months of April, 20 months of May over this time period from 2005 to 2024. 84% of the time, right, of those 20 months in April, XLU, the utilities, close higher month over month, as in it closed higher than March. Similar, March over February, 75% of the time. So seasonality says that utilities are strong in the month of March and April. And then January and February, they're not as strong. Only half, it's 50-50. Half of the time they're up, half of the time they're down. And the only other month which also looks decent at about 80% odds is in October, when utilities do well. And guess what you're noticing? This is the classic cyclicality of the market. If you look at a market, 1 year horizon, the months that are to be watched out for, the months that are bearish in general, is the month of October. No wonder utilities outperform at that month. 80% of the time they're higher. And then the months of March into April, and no wonder utilities outperform. So given that seasonality, knowing that utilities could outperform, let's look at what does the daily chart of the utility ETF XLU tell us. Interesting enough, it yesterday tested a key neckline at 62.6. It tested that in early February as well. It is kind of plotting out an inverse head and shoulder. So from 62, it pulled back towards 60, near 59.86 as the left shoulder. Then it went back and tested that neckline again, near 62.5, 62.6, pulled back to 59.14 to form a head, back at the neckline. And today it pulled back to as low as 60.96. Another day or two, it might kind of pull back, form a right shoulder, and then from there, it could reverse higher. The measured target on an inverse head and shoulder is you take the neckline at 62.6 and you take the head at 59.14, subtract the 2. So that's about 3.48. So add 3.48 to 62.42, you're going at 66.1. That's the measured target, which is very close to the previous high in December at 66.08. So that's a potential place. The other bullish things in this chart is the accumulation distribution, which means money is flowing into utilities over the month of February, has been climbing. That means smart money is beginning to move some money into utilities, expecting a market pullback in March, which means the utility part of the portfolio will do well. And also the PPO is just about to cross over the zero line and start trending higher, which is forming from a bearish to a neutral to a bullish part of the traversal, which means utilities are setting up for a move higher in the next few weeks, in the next month or the month after. With that, let's stop the recording, and now I'm going to open it up for interactions, questions, and so on. I can just go here.